So today we're going to look at some of the worst performing ETFs right now on the ASX. All of these ETFs have negative returns right now at the time of filming, and we're going to look at some of the reasons why this is the case. So I'm actually going to change these lights to red to kind of symbolize the negative returns. So okay, that should be better. My English teacher must be proud. Hey guys, welcome back. My name is Fyzee, and on this channel we look at the stock market sometimes as well. It is not just home loans, so let's just jump into it. So before we start off, I just want to say that this is not financial advice. We are looking at things from a general point of view. Please do your own research. We are just discussing things on a general basis. The knowledge and resources that I have are the same as yours, so it's all very general. Now, another thing is that these ETFs are performing so badly because they are niche ETFs and they only look at a specific sector of the market, not the broad market in general. And generally, broad market ETFs that track an index have generally done quite well, historically speaking, of course, and we, including myself, expect them to keep doing well with a few bumps along the way, of course. So the first ETF that we'll look at is a BetaShares ETF with the ticker code OOO. This is the BetaShares Crude Oil Index ETF, currency hedged. So basically this ETF helps investors to get exposure to the crude oil futures. But an interesting thing about this ETF is that this ETF hedges the US dollars to the Aussie dollar. And the reason being, of course, is that oil is usually priced in US dollars. Therefore, it's kind of like an extra layer to help Australian investors avoid the currency exposure risk. Now, this type of ETF is obviously not for everyone. It is certainly not for me, but it was quite interesting to look into it. And apparently you can only buy this ETF after 11 a.m. So between 11 to 4 p.m. for some weird reason. So this ETF is generally to get exposure to oil, as 100% of the asset allocation is in oil. And it has a super high management fee of 0.69% per year. And if we look at the charts, the 1-year return is minus 66% at the time of filming. The 5-year return is minus 57%. Now, if you've been following oil, you would know that on the 20th of April, the WTI oil prices went into negatives from nearly $18 to nearly minus $38 per barrel. Now, this is a huge drop because of the lower demand for oil throughout the world as a result of COVID. And the very interesting thing is, this has literally happened only once in the history of oil. So there you have it, guys. There's a first time for everything. Next up on the list is ASX Fuel, literally fuel, the stuff that you put in cars. Once again, this is a BetaShares ETF. No surprises there. So Fuel is BetaShares Global Energy Companies ETF. This is hedged again. Now, this one is quite simple and not as complicated as the one before. It basically tracks the performance of the largest global energy companies that are not based in Australia. This is hedged into Australian dollars as well. Now, this ETF is quite similar to the one that we discussed before, and it's mostly oil companies which make up the majority. And there's some big names on there as well, like ExxonMobil, Chevron, Shell, BP, etc. And the management fee is slightly less, but it's at 0.47% per year. The 1-year return for this ETF has been minus 28%, mostly because of these huge oil companies decreasing in value, and the return since inception is about minus 19%. Now, personally speaking, this sector doesn't really interest me because it's mostly fossil fuels, and these companies aren't really interesting as well. And it's not just because I'm virtue signaling. I just find that these companies don't help out the world in the best way possible. What do you think? Okay, so let's step away from the oil and the fossil fuels and all this stuff, and let's look into ASX MVA. This is the Van Eck Vectors Australian Property ETF. And if we look at it, this ETF is down 13% for the year, and the 5-year return is okay at about 18%. Now, why is this ETF down 17% for the year? Well, this is because this ETF tracks the index, which is MVIS Australia A-REITs Index. And what exactly is this? Well, this index has 15 components of different companies and different REITs, which are real estate investment trusts. And inside this, each company has a different weighting, all adding up to 100%, of course. And in this, you've got some big names like Stockland, Scentre Group, Mirvac. And these are huge companies that own commercial property like office spaces, warehouses, shopping centers, and by me giving you all these examples, you can probably see why they're down for the year. Because of COVID and work from home, office leases aren't being renewed as much as they were before, and people aren't visiting shopping centers as much. Oh, well, I guess they are now, but before there was a huge dip. So this ETF is basically tracking this index, and they give out a semi-annual dividend, and the management fees are about 0.35%. And since they pay a decent dividend, The total return since the fund started out is actually really good at 11%. Now there are similar ETFs out there like ASX, SLF, managed by State Street. It tracks properties as well, and it has similar holdings to the one that we just discussed. And the management fee is about 0.4% per year. And the 1-year return for SLF has been minus 20%, and the 5-year return has been just positive at about 0.4%. And lastly, for Australian property, we have another ETF called VAP, which is listed by Vanguard. Now they give quarterly dividends, and the management fee is actually the best out of all these 3 ETFs at 0.23% in true Vanguard fashion. The 1-year return is about minus 16%, and the 5-year return is about 6.5% for this ETF. Now this is it, guys. On to the last ETF on this list, but before we do, please leave a like or subscribe if you're finding value so far. It really helps out a lot. Alright, so this ETF is called ASX YANK. Yes, YANK as in the Americans, YANK. I used to think this was insensitive towards Americans, but apparently they have made an ETF about it, so I guess it's not as bad. Anyways, this ETF is by Beta Shares once again, and this one is probably one of the most riskiest ETFs out there on this list. So essentially, when the American dollar gets stronger and the Australian dollar gets weaker in comparison, this ETF will go up in value. But the thing is, it won't just go up 1% if the USD is 1% stronger. It will actually go up by 2% to 2.75% in comparison. So basically speaking, it is risky because the returns are magnified by 2 times to 2.7x. And this is classified as a leveraged ETF. And if we look at the 1-year graph, the return was the highest at about 46% around mid-March because the Aussie dollar was super weak back then. But now, as you know, the Australian dollar has rebounded back and is getting quite stronger. Therefore, this ETF has fallen in value quite a bit. And by how much has it actually fallen? By around 30%, which is quite huge. So you can invest in this product if you believe the Australian dollar will weaken. But just remember that the management fee for this ETF is 1.19%. So realistically, it is more of a short-term play, not something you want to hold on to for the long term, unless you want to do that. It is really only for the quick profits. So that is it, guys. Let me know what you think about this list. I think it's interesting to explore some of the ETFs which haven't done so well in the past, so we can potentially find some opportunities, or if not, we can just learn something new. And we can pretty much know what to avoid in the future. So guys, thanks for watching. I appreciate it. Please like or subscribe if you enjoyed the video, and click the notification bell. I really appreciate your time. Thanks. I'll see you in the next one. Yeah.